A very good evening to all the participants of this webinar. From DTRTI Lucknow, I'm Arvind Mishra welcoming you to this webinar in which we will be discussing bank reconciliation statement as part of our bookkeeping and accountancy series. Friends, in this webinar, you'll be studying the design of a bank passbook. You'll also understand the reasons for why there is a difference between the cash book balance and the passbook balance. And we'll also try to ascertain the amount of such difference. Besides, we'll also learn how to resolve the difference in a systematic manner so that we are aware of the reasons for the difference. And we would like to understand the purpose for preparing the bank reconciliation statement and the utility of preparing the bank reconciliation statement. So when we prepare the bank reconciliation statement, the important or the salient features of a bank reconciliation statement is that a reconciliation statement will bring out any errors that may have been committed either in the cash book or in the passbook. That is number one, that it will bring out the errors. Number two, if there is an undue delay in the clearance of any check that has been deposited, it will get shown up in the reconciliation statement, or it will get revealed by the reconciliation. And thirdly, a regular reconciliation discourages the accountant of the bank from embezzlement. If we keep on reconciling, the accountant would think that I will not be able to fool my bosses, and therefore embezzlement will become very difficult for him if he knows that reconciliation would be done from time to time. To reconcile means to understand one thing from the other's point of view, to see from the other's point of view, to see the other person's perspective. So here we reconcile the bank passbook from the perspective of the cash book, and we reconcile the cash book from the bank passbook's perspective. Now, what are the differences? What are the causes of the differences in the passbook balance and the cash book balance? The differences can arise due to timing, like the check has been issued but not deposited. There is a time gap between the issue and deposit of the check. And the difference could be due to errors in writing the entries in the cash book or in the passbook. So we have to understand the difference could be due to the timing or due to the errors. Now, as an introduction to this chapter, we can say that banks are very essential institutions. As the trade, commerce, business is increasing, there was difficulty in transacting in cash for each business activity. So therefore, banks emerged, and dealing through banks made it easier to deal in cash on a regular basis. It was a safer option also. It was a better option also. And therefore, many business entities switched over to banking transactions rather than through the cash transactions. Nowadays, most of the transactions of the business are done through the bank, whether receipt or the payment. Rather, it is legally necessary to operate the transaction through the bank after a certain limit. It has been statutorily also made necessary to do so. Now, a bank accepts from people in general deposits in various forms. and they lend the funds which they have received as deposits to those who need it. Banks also invest some funds in profitable investments, and thus money that would have been idle is put to use and made available to those who need it. So banks are a channel for channelizing the money to productive use. All those who deposit the money are able to withdraw also, according to the settled terms and conditions. Now, apart from receiving deposits and handling cash transactions on behalf of the customers, banks render other services also. Now, among the services that banks render, one is the bill discounting, or the discounting of the promissory notes or hundis, which enables a customer to receive the cash even before the due date of the promissory note in consideration for a small charge, which we call a discount or bank charge. Another facility the bank gives to the customers is that it allows the overdraft to good customers. I mean, they can withdraw money in minus. I mean, they can withdraw more than they have deposited, so that they can make payments even when they do not have the sufficient balance in their bank. Of course, this overdraft must be cleared later on. Thirdly, the bank gives loans for a year or so to its customers so that they can continue their operations, which are called working capital loans. Such financial assistance is of great help to the business. Now, the bank on behalf of the customer collects the dividend warrants or interest on the securities. So these are the collection services, the dividend collection and the interest collection. Thereafter, on the instruction of the customer, bank can make the payment of insurance premium, of rent, etc. on the due dates. Next, the bank sells and purchases the shares, debentures or government securities on behalf of its customers. So it has a brokerage role also. Money can be sent from one place to another or from one person to another through the bank at a very low cost. Next service that bank gives is the bank, in return for a consideration, furnishes a security, or what we call a bank security or bank guarantee, for its customers whose credit is good with them. The bank also issues letter of credit or traveler's checks to those who are traveling abroad or traveling to other places from their hometown, because it facilitates the commerce or travel. The traveler's checks can be used anywhere to make purchases or payments. So you don't have to carry currency with you because there is a risk in carrying the currency. Now let us understand something about the bank passbook. The bank passbook is merely a copy of the customer's account in the books of the bank. The bank either sends periodical statements of the accounts or it gives a passbook to its customer, in which all the deposits and withdrawals would be written for a particular period. So, in a way, it is a copy of the ledger account of the customer in the books of the bank. So, it is bank's way of keeping the customers informed what entries is it making in their account. And it is also the customer's duty to check the entries and inform the bank of any error that he may notice. The passbook is generally in this form, that the name of the account and the name of the bank, then address of the bank, and then of course the date, particulars, withdrawal or deposit amount, whether it is debited or credited, and the balance. These are broadly the columns in any passbook. Now, the bank statement of the account also has a similar form as the passbook. So this is a passbook format. Even the statement of account has a similar form, except that the statement of account is on loose sheets. It can be printed on loose sheets also. The bank itself sends the statements to customers, but it is the customer's duty also to send the passbook to the bank periodically so that it gets written up to date. Now, business houses should also obtain at the end of the year a certificate from the bank stamped with the revenue stamp showing the balance which the bank has in the account of the firm. So this practice was there to obtain at the end of the year this certificate, because this was another area or way in which revenue could come to the government. The bank balance shown in the passbook is known as passbook balance for reconciliation purpose. The credit balance as per the passbook at a particular point of time will be the deposit made by the customer, and the debit balance as per passbook will be the overdraft balance for the customer. So if there is a credit balance, we can say there is a deposit, net deposit, and if there is a debit balance, we can say that there is a overdraft balance for the customer. It may be noted here that the nature of the balance shown by passbook and cash book is quite different. If there is a debit balance in the passbook, it represents the credit balance as per the cash book. And if there is a credit balance in the passbook, it represents the debit balance as per the cash book. And the reason for this is that the business enterprise treats the bank as its debtor or as its trade receivable. And the bank in turn treats the business enterprise as a creditor or as a trade payable. So due to that difference, the debit balance in the passbook will represent the credit balance as per the cash book, and the credit balance in the passbook will represent the debit balance as per the cash book. Now, let us come to the bank reconciliation statement. When we say reconcile, we mean to find out the difference between two things and try to eliminate that difference. In other words, as I said, seeing one thing from the other person's perspective or from the other side. When we deposit or withdraw money from bank, it is recorded in two places. Firstly, we record it in the bank column of our cash book. And secondly, it gets recorded in the bank passbook of the bank statement, which is maintained by the bank. The first one is maintained by the depositor, and the second one is maintained by the bank. The first one, that is the cash book, is maintained by the person who is having the bank account in the bank, whereas the bank statement is prepared by the bank. Therefore, normally, and as it should be, the balance in both should be equal and opposite in nature. Opposite means if there is a positive balance in one, there should be an equal negative balance in the other. For example, if Mr. A deposited 1 lakh rupees in his bank account, it will be recorded on the debit side of his cash book that he has deposited 1 lakh rupees in his bank account. It will go into the bank column, of course, but on the debit side of the cash book, because 1 lakh rupees has been deposited in the bank account, and therefore the cash book is debited by that amount. But for bank, it is a receipt of money, so the bank will record it as a credit entry in the bank statement or in the passbook of Mr. A. But most of the times, these two balances, however, do not match. And what is the reason for the difference and why it is not matching? The reasons can be many, and we'll come to that later on in our discussion. It is possible to eliminate this difference by matching all the facts and figures of the two statements. So we match each and every fact and figure of the two statements, and then we can find out the difference and eliminate the difference also. The process of eliminating the difference and bringing the two statements in line with each other. When we are eliminating the difference and bringing the two statements in line with each other, it is known as reconciliation. And the statement which reconciles the bank balance as per cash book with the balance as per passbook by showing all the causes of difference is known as a bank reconciliation statement. So bank reconciliation statement is a statement which reconciles the bank balance as per cash book with the balance as per the passbook, and it shows the causes of the difference also. Now, what is the importance of having a bank reconciliation statement? The bank reconciliation statement, PRS, is an important, very important tool for internal control of the cash flow. It helps in finding the errors, in finding frauds, in finding irregularities that have occurred at the time of passing entries in the cash book or in the passbook. Whether these error, frauds, and irregularities were intentional or unintentional. Since frauds can be detected on the preparation of the bank reconciliation statement, therefore accountants are very careful in preparing and maintaining the records of the business enterprise. Why the accountants are careful? Their mistake may get caught while preparing the bank reconciliation statement. Hence, it is an important mechanism also for internal control. Now, what are the salient features of the bank reconciliation statement? Number one, the reconciliation will bring out any errors that may have been committed either in cash book or the passbook. First thing is that we can come to know of the errors that have been made while writing the cash book or the passbook. Secondly, any undue delay in the clearance of the checks will also get shown up by doing the reconciliation. And thirdly, the accountant will be discouraged from embezzlement. In many cases, cashiers merely made entries in the cash book, but they never deposited the cash in the bank. The cash book entry was there, but in the bank, they did not deposit that. So they were able to get away with it only because there was a lack of reconciliation work being done. And fourthly, it helps in finding out the actual position as to how much is the cash, which is the bank balance or the money in the bank. Now, these were the salient features of a bank reconciliation statement. Now we come to what are the differences, the causes of the difference in both the balances. The difference in both balances may arise due to any of the following. For example, it may arise due to the timing problem. Sometimes a transaction is recorded at two different times in cash book and passbook. For example, Mr. A has issued a check to PQR Limited now. Now it will record in his cash book immediately, but the bank will recognize this transaction only when this check will be presented to it by PQR Limited. So there is a difference of timing here. Similarly, for PQR Limited, any entry in the cash book will be made immediately as the check is received from Mr. A, but the bank account will be credited only when it collects the money in respect of that check. Now let us go into second cause of difference between the passbook and the cash book, and that is transactions. There are various transactions which the bank carries out by itself without intimating the customer. For example, interest is credited in the savings bank account, but cash book entry will come only later on when the customer comes to know about the entry at a later stage. Similarly, the bank also charges its bank charges for various services that the bank gives, and these are debited from the customer's account by the bank. And thirdly, the difference is due to the errors. Like mistakes or errors which are made in preparing the accounts, that also lead to difference between the passbook and the cash book. And therefore, we need to rectify those errors in both the statements before preparing any bank reconciliation statement. So the bank reconciliation statement is prepared later on, and the rectification of errors is done earlier than that. Now let us look at some examples of the items that frequently cause a difference between the bank passbook and the cash book. Number one difference, the cause of the difference, is checks which were issued but not presented for payment. Now this is the timing difference. The entry in the cash book is made immediately when the check is issued, but the entry will not be made by the bank unless and until the check is presented for payment. Therefore, there will thus be a gap of some days between the entry in the cash book and the entry in the passbook. Example, the balance as per cash book and the passbook are 10,000 rupees. Then the check of 2,000 rupees is issued but not presented for payment. Then the balances as per cash book and the balance as per passbook will be like this, that as per cash book, in the bank column, the balance brought forward was 10,000 rupees, and a check of 2,000 is issued, and therefore the cash book is credited with that check amount 2,000, and the balance carried forward will be 8,000 rupees. But of course, on the issue of the check, the bank account and cash book is credited by 2,000. And so the balance is reduced to 8,000 rupees, whereas the balance in the passbook is 10,000 rupees until the check is presented for payment. So there is no impact on the bank statement or the bank passbook till the time is brought forward till what I mean to say is that the balance in the bank statement will show 10,000 rupees, And on the issue of the check, the bank account in cash book will be credited by 2,000 rupees. And therefore the balance will be reduced in the cash book to 8,000 rupees. But in the passbook it will remain at 10,000 rupees. So that will be, there will be a difference of 2,000 rupees between the two. Now let us look at another reason why there is a difference between the cash book and the passbook. The reason is the check which are paid into the bank, but they are not cleared. As soon as checks are sent to the bank, entries are made on the debit side of the bank column of the cash book about those checks. But usually the bank will credit the customer's account only when they have received the payment from the concerned bank. So the customer account has not been credited, but it's not been debited, but rather not been credited, but the payment is gone. So usually the bank credits the customer's account only when they have received the payment from the concerned bank. In other words, when the checks have been cleared. So again, there will be some time gap between the depositing of the checks and the credit given by the bank. Meanwhile, if accounts have to be prepared in between, then we'll have to prepare a bank reconciliation statement. Now let's take an example of this. The balance as per cash book and passbook are 12,000, and then a check of 3,000 is deposited. When the check of 3,000 is deposited, we debit the cash book by 3,000 and credit the vendor account. So thereby, there is a cash book balance of 15,000. In the bank passbook, the balance is only 12,000. The third reason is interest which is allowed by the bank, but it has not been entered in the cash book. As soon as the bank allows the interest to the customer, they pass the entry in customer account and it will be shown in the passbook when that is printed. The customer comes to know about the amount of interest by perusing the passbook, and only then he makes relevant entry in the cash book. Now, example for this is that the balances per cash book and passbook are 10,000. Then the bank has allowed 1,000 interest on saving account to customer. So obviously, there is no entry of this 1,000 in cash book, but there is an entry in the bank statement where this 1,000 has been credited out here. So therefore, now the balance including interest is 11,000 crore, 11,000. Now, because of such interest, balance of passbook is increased. Because of the interest, balance of the passbook is increased to 11,000, whereas the balance in the cash book remains at 10,000 until information will reach the customer and he will record the transaction. Now, the next reason for the difference between the passbook and the cash book is interest and expenses which are charged by the bank. Sometimes the bank will charge interest and the amount of bank charges are entered in the customer's account and later in the passbook also. The customer makes the required entries only after he sees the passbook, because the customer doesn't know that the bank has credited the interest and expenditure. And charge the expenditure. These are all debited to customer account by bank. Therefore, till such entry is passed in the cash book, bank balance as per passbook is less than the bank balance as per cash book, because bank has already charged interest and bank has already charged expenditure, but the same has not been entered in the cash book, and thereby the bank balance as per passbook is less than the bank balance as per the cash book. Another reason is the interest and dividends which are collected by the bank. Investments are left with the bank in the safe custody, and the bank itself makes sure that the interest or the dividend is collected on the due dates. So bank gives the service of interest or dividend collection on the due dates. For example, you can take the balance as per cash book and passbook are 15,000. Thereafter, the bank has collected the dividend of 2,000 rupees, and as we can see, this 2,000 rupees dividend has been collected by the bank and entered in the bank passbook. So whenever a dividend is collected, the bank will credit the amount to the customer's account, so that balance in passbook is increased to 17,000. Whereas in the cash book, the balance is remaining 15,000 until the information of such dividend collection will reach the customer, and he will make the recording entry in his cash book. Now let us come to the next reason why there could be a difference between the cash book and the bank passbook. Sometimes the banks are given standing instructions for certain payments, such as the insurance premium. So bank will pay this amount, but it's not recorded in the cash book. Like insurance premium, and in this case also the customer may come to know of the payment only on seeing the passbook. The entries in the passbook and in the cash book could be on different dates also. Okay, now there is an example. The balance as per cash book and passbook is 20,000. Now bank has instruction to pay insurance premium of 1,500. So bank pays 1,500 and that gets reflected in the bank statement. But there is no reflection of that in the cash book so far. Now when the bank pays the insurance premium, it debits the customer account by 1,500. So the balance in the passbook will decrease to 18,500, whereas balance as per cash will remain at 20,000 until information will reach the customer and he records such transaction. Now let's see another reason why there is a difference between the bank passbook and the checkbook. Bank passbook and the cash book. Now, sometimes direct payment is made into the bank by some customer. So if the payment is made into the bank by the customer, it will be entered in the customer account. It will be entered in the customer's account in the cash book and also in the passbook. The account holder may come to know of the amount only when he sees the passbook, and therefore he will make the entry later on. And before he makes the entry, the bank passbook will show a greater amount of credit than the cash book. Thereafter, point number 8 says that the dishonor of a bill discounted with the bank a bill has been discounted with the bank and it gets dishonored. So bank is not able to receive the payment on that promissory note which it had discounted. So it will debit the customer's account along with the charges it may have incurred or expenditure which it may have incurred. The customer will naturally make the entry when he sees the passbook. So that will come later on. Example is the balance as per cash book and passbook was 20,000. Then Mr. X deposited a check of 3,000 and debited to his bank account 3,000 immediately. So, of course, when he deposits a check of 3,000, he will debit that to his bank account, the same amount immediately, but the bank will credit X's account on realization of the amount. The bank has not credited X's account, though X has already debited to his bank account 3,000 rupees. Now the check is dishonored because of non-payment, and in such a situation, the bank charges of rupees 100 is to be accounted for. Now in this case, we can say that 20,000 was the brought forward balance, and then 3,000 is entered on the debit side of the cash book because Mr. X has deposited a check of 3,000 rupees, so therefore it will appear in the cash book because he has deposited this check, but it has not been cleared in the bank. So obviously, in the bank passbook it will not show. And then we come to the ninth reason why there is a difference between the bank passbook and the cash book. Sometimes the bills which are collected by the bank on behalf of the customer. If goods are sold, the documents may be sent through the bank, and if the bank is able to collect the amount, it will credit the customer's account. And customer will make the entry perhaps only on the receipt of his cash book duly filled in. So like this, all these are the timing differences will lead to differences which lead to ultimately differences in the balances as shown by the cash book and the passbook. Now we have a table summarizing in brief the timing of the different transactions. For example, when there is a payment done by the account holder through issuing a check, in the cash book he records it at the time he issues the check, but in the passbook it will be recorded at the time he presents the check to the bank for the payment. Then secondly, if the account holder receives a check, he will credit at the time of depositing the check into the bank, he will record it in the cash book, and at the time of collection of the amount from the account of the issuing party, it will get recorded in the passbook. Similarly, for collection of bills or checks on behalf of the account holder, in the cash book it will be recorded when the entry is posted in the passbook, and in the passbook it will be recorded when the amount is collected by the bank. Similarly, there are a number of other transactions also where we can see when the entry is made in the cash book and when the entry is made in the passbook. Now let's say there is a direct payment to the third party on behalf of the account holder. On behalf of the account holder, somebody else is making a payment to the third party. Now when in the cash book it will be recorded when the entry is posted in the passbook, because once this entry gets posted in the passbook, the entry can be made in the cash book. And in the passbook, it is entered when the amount is paid by the bank. Similarly, in case of the dishonor of the checks or bills receivable, it will be recorded in the cash book when the entry is posted in the passbook. And in the passbook, it will be recorded when the check is dishonored. Now, next is the transaction of bank charges levied by the bank. It will be recorded in the cash book when the entry is posted in the passbook, and it will be recorded in the passbook when the charges are levied by the bank and entered in the passbook. Then next transaction is interest and dividend, which is credited by the bank because it is collected and credited by the bank. It will be entered in the cash book when the entry is posted in passbook, and it will be entered in the passbook when the interest or dividend is allowed or collected by the bank. And eighth, in the last reason, is interest debited by the bank. The time of recording cash book is when the entry is posted in the passbook. Posted in the passbook means the bank is posting it. And in the passbook, it will be recorded when the interest is charged by the bank and entered in the account of the customer. Now let us take an illustration. We are seeing an extract from the passbook and the bank column of the cash book. We are seeing this illustration. Now here we have a passbook in which we have the date, the number or the folio number, the particulars, the date and the particulars, and withdrawals or deposit, whatever it is, debit or credit, and the balance. So various entries are there in the bank passbook. Now then we have number of entries in the cash book also. Now we are seeing here that whereas the passbook shows a credit balance of 2,43,000 rupees. Here you can see passbook is showing 2,43,000 rupees, but the balance carried down is 2,37,000 rupees as per the cash book. So we'll try to compare the two first of all to find out the reasons for the difference, and we write down the reasons for the separately, and then we make the reconciliation of the two statements. So the reconciliation is made of the two statements in two ways. The first is we arrive at the passbook balance from the cash book, and second is that we arrive at the cash book balance from the passbook. In the first method, we start from the cash book and then we go towards the passbook balance, and in the second method, we start with the cash book balance. We start with the passbook balance and go towards the cash book balance. So let us start with the passbook balance and then arrive at the balance as per the cash book. So we compare the debit side of the cash book with the deposit column of the passbook carefully, and we find that there are two checks which are recorded in the cash book, but they are not recorded in the passbook. Therefore, if we enter these two checks in the deposit side of the passbook, the balance becomes 3,82,000. Existing balance is 2,43,000. We are entering it in the deposit side of the passbook, which was not entered earlier, 1,05,000 and 34,000. And finally, the total balance as per the passbook becomes 3,82,000 rupees. On the other hand, we compare the credit side of the cash book with the withdrawal column of the passbook, because these are equivalent columns. We find that there are a few checks which are not recorded there. Therefore, if we enter these two checks on the withdrawal side of the passbook, since they are not entered there, then the balance becomes 2,31,000 rupees, because these are the two checks which have not been recorded. So now we are recording them in the passbook, and then our balance, which was existing balance 3,82,000 rupees, comes down to 2,31,000 rupees. Then, of course, there is an item called interest on government securities, which appear on the deposit side of the passbook, but it does not appear on the debit side of the cash book. So this item should also be deducted from the passbook balance, and once we deduct that, we come to 2,11,000 rupees. So as we can see here, that there are two items more which appear on the withdrawal side of the passbook. That is, they have been deducted from the bank balance, but not on the credit side of the cash book, which they should have appeared. So these items should be added in order to reconcile the balance. So we add these two items, 25,000 and 1,000, and then we get 2,37,000. Now, this 2,37,000 is the balance, as we can see here, as per the cash book. We started with the balance as per the passbook 243, and we reached up to the balance as per the cash book 237 by a certain journey. We kept on comparing the equivalent columns and then adding or subtracting, and thereby we reach the right balance. Now, when we go through this process of finding the difference, this process shows that the difference between the two balances in the cash book and the passbook arise only because there are some entries which are made in the cash book, but they are not made in the passbook, and there are some entries which are made in the passbook, but they are not made in the cash book. And due to that, the difference was arising. So we compare the two, and when we compare the two, the bank passbook and the cash book, it shows up such entries which are the difference between the two accounts, and then the passbook and the cash book. And then once we cull out the reasons for the difference, then on that basis the reconciliation is prepared. Now, we have started from the bank passbook balance and we have reached the cash book balance. Similarly, what we can do is that we can start with the cash book balance of 2,37,000 rupees, and we can reach up to the bank passbook balance also. Let us say that we are starting with a cash book balance of 2,37,000 rupees. Then we are finding certain checks which are totaling 1,39,000 rupees, which are not there in the passbook. So let us assume that they are also omitted from the cash book, and this will reduce the cash book balance from 2,37,000 to 98,000 rupees, because we are starting with the cash book balance, trying to proceed towards the passbook. Now these two checks have not been entered in the passbook. Why should we enter it? We should also reduce it from this amount of cash book balance. So 2,37,000 rupees minus 1,39,000 rupees, we get 98,000 rupees. Apart from this, we notice that checks totaling 1,51,000 rupees have been entered on the credit side of the cash book. That means these are the checks which have been issued, but they are not entered in the passbook for whatever reason. So their omission from the cash book will increase the. So if you have to move towards the bank passbook, then we'll have to omit them from the cash book also. So by omitting them, it will increase the cash book balance to 2,49,000. We are adding up 151 to 98. Or rather, what we are doing is that we are from 237. The cash book balance was 98,000, and when we add 1,51,000 to it, we get 2,49,000. Now, after doing this, we have got an amount of 2,49,000. Now, we find that amounts totaling 26,000 have been entered in the withdrawal column of the passbook, but not entered in the cash book. So we make an entry on the credit side of the cash book for these amounts, so that will reduce the balance to 2,23,000 rupees. You must always remember that we are moving towards the bank passbook from the cash book. Now we have a balance of 2,23,000 rupees. Now we look at the deposit column and we find that an entry of 20,000 rupees, which is not found on the debit side of the cash book. So the entry is made in the cash book, will increase the balance from 223 to 243. And 243 is the balance as per the passbook. So in this manner, we have reached the passbook from the cash book. So we can reach the cash book from the passbook or the passbook from the cash book. So either way we do it, we are preparing a bank reconciliation statement. In order to just recapitulate what is happening here, we see that we have a passbook, and in the passbook we find that there is a balance of 2,43,000 rupees at the end of January 31, 2017, and once again at the end of January 31, 2017, in the cash book we have a balance of 2,37,000 rupees. So if we were to start from the passbook balance, then we have to see what are those entries on the withdrawal side or on the deposit side. One by one, we go on finding out those entries which are there here, but they are not in the cash book. So in order to start from the balance of the passbook and move towards the balance of the cash book, we have to see if there is something which is not there in the passbook and which is there in the cash book. So since it is there in the cash book and we have to go towards the cash book, so we will include that entry in this balance. So we'll include all those entries which are there and which are there in the cash book. On the other hand, if there are some entries which are not there in the cash book, but they are over here, so we'll reduce those entries, we'll cut out those entries in order to move towards the cash book. Now, to cut out and move the entries, if there is a entry on the withdrawal side that is reducing the balance, and the entry is on the deposit side that is increasing the balance. So based on that, we'll reach a conclusion. So first we'll see which are those entries in the withdrawal column, which are there in the cash book, but not in the bank book. Then we'll see those entries in the withdrawal column, which are there in the other book and not there in this book, like that. And similarly, we'll go to the deposit column and we'll find out the entries correspondingly. Having found those entries, we'll decide whether we want to move from the passbook towards the cash book or whether we want to move from the cash book to the passbook. And accordingly, depending upon the direction that we are taking, we make minus and plus entries in order to reach the other book. And this direction that we are taking in order to reach the other book is called the bank reconciliation. Now the 10th reason why the difference is there between the passbook and the cash book is the errors. Because while recording the entries in the cash book or in the passbook, some errors could get committed. Though bank will rarely make any error, but if it does, the balance in the passbook will naturally differ from the balance in our cash book. Similarly, if we make any error in writing the cash book, then the cash book balance will be different from that of the passbook balance. Now, some of the errors that could be possible include the commission of entry. It is a error of commission, which means that an entry is there, a wrong entry, then a wrong recording of amount, then it could be a recording of entry on the wrong side of the book, like instead of debit side is made on the credit side. An entry could be a wrong totaling of the account or wrong balancing of the book, and sometimes instead of one party, the transaction of some other party is recorded. These are all the errors that are made while recording entry in the books or in the passbook. So we can read an example here that in Mr. A's cash book there are some transactions. So we are seeing these transactions in the cash book. March 31 balance carried down is 1 lakh. Then on April 7, cash book is debited, which means payment is coming from Wayne Limited of 60,000. Then of course there is a cash deposit of 80,000 rupees. And there is a cash withdrawal of 2,000 rupees and balance brought down of 10,000 rupees. And similarly, we have a passbook also. If we look at the if we look at both the books, we find that there are several errors that are made by the accountant. First of all, on April 1, the balance should have brought down the debit side as 1 lakh rupees. The balance brought down this one. It is wrongly mentioned as 10,000 rupees, though it should be 1 lakh rupees, and it should be brought down on the other side. And another error is that a check which is issued to Vandy Limited has been omitted in the books of accounts. So a check is here 90,000. It is issued, but this check is nowhere finding any place here in the cash book. So in this way, when we correct these two entries, the balance as per cash book, right now the balance as per cash book, the balance carried down is 1,28,000 rupees. So we start with the existing balance 1,28,000 rupees. We are adding the correct opening balance 1 lakh rupees. Then we are adding the incorrect opening balance. Since it was brought down on the credit side, it will be added back as it was on the wrong side. So 10,000 rupees. And checks which are issued but not recorded of 90,000 rupees. We'll record them now. And finally, we come to closing balance as per cash book of 1,48,000 rupees. Now, balance as per passbook is 3,28,000 rupees, and if we reduce the check to Wendy, which was wrongly added to existing balance instead of being subtracted, it was added earlier. We subtract it now, we get 1,48,000 rupees. And so the difference in the balances between the cash book and passbook is now nil. So by this example, what we are trying to see is that how the errors get committed, and therefore these errors are identified and they are rectified in the process of making the bank reconciliation statement. So this particular illustration deals with the errors that are made and due to which the bank reconciliation statement is required to be prepared as is being prepared here. Now we come to what is the procedure for reconciling the cash book balance with the passbook balance. And for this procedure we'll be continuing with the session tomorrow morning at 8 a.m. So please join us at 8 a.m. tomorrow morning for the remaining part of the session on bank reconciliation statement. And please try to revise whatever has been studied today also. Thank you very much for having joined us in this session. Please join us back in the morning, tomorrow morning at 8 for the session at 8 a.m. Please join us at 7:45 a.m.